Welcome to Trading Nation. I'm Sara Eisen. Today we're asking a simple question. What is wrong with the bank stocks? While the broader market is up 9% this year, banks are up just 2%. And one of our next guests is pointing to another issue lately with the group. That is, banks are failing to rally even as rates rise. So how do you trade the group here? Mark Tepper is with Strategic Wealth Partners. Matt Maley is with Miller Tabak. So Matt, you point out in your latest note that banks are not getting a lift from higher rates. What does that tell you?
Well, I think it's a concern about that they think that rates aren't going to break out here. I mean, we saw the same thing happen a couple of months ago when the last time that the 10-year note, the yield on the 10-year note got up towards 3%. The bank stocks did not rally along with that. And when interest rates are moving higher, you would expect them to do that. Well, sure enough, the long bond rolled back over and traded down back to 2.8% or close to 2.8% rather quickly. I think we're seeing the same kind of thing here. I mean, remember, at the beginning of the year, we had people calling for 3.5%, 4% or higher. That hasn't panned out, and so these bank stocks haven't rallied either. At the same time, the utility stocks have rallied, even though interest rates have been moving up. So I think these two groups are telling us that they do not see a big breakout in interest rates, at least on the long-term interest rates, anytime soon.
Mark, what's your take on the banks?
So I think we've definitely seen rates increase this week on the 10-year, but the 2-year has actually increased more. So the yield curve is now even flatter, which should hurt net interest margins for the banks, and that explains why the banks haven't rallied. So we are a believer in higher interest rates. We do think they're going to go higher over the course of the next year, but we also have a contrarian perspective on what that actually means for bank stocks. So yes, rising interest rates can, in theory, help net interest margins, but they can also curb lending. And housing has already come under some pressure with rising rates, and we're concerned that that could be a sustained trend, and that would hurt the banks. So overall, when it comes to banks, we're fairly neutral, but we do prefer the mega cap banks that have more exposure to capital markets. Reason for that is, we're also believers in volatility, and that is going to help to drive trading revenues. So at this point, we'd steer clear of the regional banks since they're more dependent on housing and business lending, and stick with those mega cap banks.
Yeah, that benefit more from the trading. Matt and Mark, thank you both for joining us and for your take on the financials. Thank you all for watching Trading Nation. I'm Sara Eisen. We'll see you next time. Hey traders, did you like that video? There's more where that came from. Scroll down and click on the links to the right of your screen. We publish new videos and commentaries from our experts every day. And don't forget to follow us on Twitter @Trading Nation.